I have not been paying quarterly taxes this year, but I am paying myself a salary, so I am saving a little bit of money as I get some taxes through that. Should I pay some quarterly taxes here in December, or should I just wait and just pay a lump sum on my tax return?
Filing quarterly income taxes as a handyman business. How do we know what to pay? How do we pay? What do we do? This footage that we are about to watch is from our group coaching call out of the Handyman Academy coaching program. So if you guys don't know, we have a coaching program that is specifically designed to help people grow their handyman business or start up a brand new one. So on our last group coaching call, we brought in my CPA, a CPA that we've been using for years, and she talked in depth about filing quarterly income taxes to the IRS. And we're gonna watch that clip right now. So without any further ado, let's get to the footage.
On the list here is filing quarterly estimated tax payments. So I don't know if that's a procedural question, but I'm gonna just kind of take you through all the details of that. So typically when you have a business, you don't have money being withheld for the income tax that goes along with that profit. That often holds true whether you file your taxes as an S corporation, a partnership, or sole proprietorship. So and we'll get to the distinction on S corps and why and all of that later. But regardless of how you file your taxes, you typically have profit that income tax hasn't been paid on. And so if it's going to put you into a place where you owe income tax when you file your personal tax return, then you are supposed to be making quarterly estimated tax payments. And those are due April 15th, conveniently on the deadline for your other taxes, right? June 15th, September 15th, and then they give you December off and let you go right into January when you're already broke from Christmas spending, because they're very thoughtful like that. Typically, I recommend people make those online at irs.gov. And the reason that I do that is because if you mail in a check, you're relying on not one, but two government agencies not to lose something. So you're relying on both the post office to get it there and then the IRS to not lose it before they even get it processed. And bizarrely, they managed to cash the check and then lose the paper that says where they would apply it. So if you just go online to irs.gov to make the payment, you have a way better than average shot of that actually being done the way that you want it to. And the way that you will do that is just go to make, right on their home screen, it says make a payment. You put in your info, and by your info, I mean whoever's name is listed on the personal income tax return first. So in most married situations, that's the husband, but not always. So just make sure when you make that estimated payment that you use the social security and name of the person listed first, and then you make that payment. Now, how do you know if you even need to make one or how much to make for an estimated payment? And that's a completely different question. So one of the things that I do with clients, if we just need to get a kind of a quick overview for where they are, is we say, okay, so first of all, last year, did you get a refund or did you owe money? If they had a substantial refund and their business income is roughly the same as it has been in the past, or even maybe 10 to 15% higher, depending on the amount of that refund, we assume they won't owe anything and we don't make estimated tax payments. If they've never had a profit, or if it's like they barely have a refund and they're pretty close to breaking even, plus or minus $500, then what I would suggest that you do is take the profit that is over what you made last year for that same period and multiply that by your effective tax rate. And your effective tax rate usually is on the first page of your tax return. And this is true whether you pay someone like myself to do the return. It'll be like a federal summary. And so like in my particular software and most of the professional softwares, there'll be a summary and it has like your W-2 wages, your business income, all of that. And there's some lines over here in the second column. And down on that bottom right corner, it tells you your effective tax rate. So let's say it's 20%, right? And so you've made, $100,000, 20%, you owe $20,000 payment, right? I just use those numbers for round easy math. If you use TurboTax or something of that nature, they're usually right on those front summary pages as well for what your effective tax rate is also. Now, sometimes giving the government your money does not actually help your business grow, right? You're like, wait a minute, I needed that 20 grand. I got to pay people, I got to do marketing, I got to do all these things, right? So maybe in that scenario, what you do is you pay 10, right? Like at least pay something. So pay half toward that. And then just monitor it along the way, knowing that you're probably either going to have a bigger payment in December or you're going to have a bigger payment at the time the tax return is due.
Hey friends, I wanted to interrupt this video real quick and let you know that I've created an Amazon store with a whole bunch of links to tools that I highly recommend and tools that we use every single day in our handyman business. And also, handyman business books. Books have been drastic to the growth of my business, and I would highly recommend that you check that out. So I will put a link in the description below where you can gain access to that Amazon store and see everything that I recommend. Also, I wanted to let you know that you can schedule a free consultation call with me over at handymanjourney.com/coaching. I look forward to talking with you soon. Let's get back to today's video.
And the reason that we do that, like let's say we start the beginning of the year with our clients, we'll say, okay, at the end of Q1, you're tracking to do double what you did last year, okay? At the end of Q1, if we multiply that by 4 and they're tracking to do double, I don't necessarily want to have them make a payment that assumes they're going to close the year at double. We're keeping that in the back of the mind and we're like, okay, if we can put a tax savings account together and set that money off to the side, you know, on our end, let's do some of that. Let's make an estimated tax payment in Q1 for what you, like if you stayed the same as last year. And then Q2, we may be a little more, so if we're still tracking to double, we'll do like 1.5 times what we would have done if it had stayed the same, and so on and so forth. If we get to Q4 and we're still tracking that, we're going to go ahead and dump all that money that we had in savings into those estimated payments, unless there's a different reason to not do that. But the reason we don't want to give it to them all up front is while in Q1, let's say that's your best quarter of the year, if we give them all that money and then by year end you didn't double your income, we just gave them a whole lot of capital that you could have been using to grow your business at no cost to them. And so we just kind of play with that along the way, but kind of make sure that you also have money set aside to cover those taxes so that you don't get yourself jammed up. Does anybody have questions on that would make sense to cover?
I have a quick question.
Sure.
I have not been paying quarterly taxes this year, but I am paying myself a salary, so I am saving a little bit of money as I guess when taxes do that. Should I pay some quarterly taxes here in December, or should I just wait and just pay a lump sum on my tax return?
Is this the first year that your taxes have been structured this way?
This is my first year as an S-corp, yeah.
Okay. So then what I would do is I would add together the net income from the business, assuming that your P&L is put together and your salary is subtracted. I would add together the net income from the S-corp P&L and add it to your box 1 W-2 wages. And if that number is close to the same as last year, if last year you got a refund or you were on the line, then factor in what your year-to-date withholding is before you make that decision. If that number is much higher, then I would go ahead and make a payment.
It'll definitely be much higher since I started in September last year, so I didn't have a ton of pay from last year, and I'm well above 100K this year. So
perfect, yeah. And yours is going to be a little bit different on your effective tax rate from where it was last year, because last year you had self-employment tax and you won't have that this year. So there's not a fast, easy way for you to get your estimated payment correct.
Okay, thank you.
I got a question kind of along those lines, but I'm not an S-corp yet. I'm still a sole proprietor. I started my business last year in August, and I think by the time it was come for tax time, it was not very much money. I'd pretty much put everything I'd made back into it. So that was kind of a wash. So this year from January to December is going to be like my first year of actually knowing what I would make, I guess you could say, in a year. And I haven't made any payments either. So I have a bunch of money saved up in case I owe, which likely I will. But you said it was pretty serious to make those quarterly payments. Is there like something they're going to look at extra, or some trouble I could get in for not making those, even though it's like the first full year?
Yep. So the way that they look at that is there's an underpayment penalty for not making the estimated payments quarterly, right? So if cash flow is a big issue, obviously the lower we keep those, the better off we are. However, that underpayment penalty is really low, right? Which is why I'm like, okay, operationally for cash flow purposes, it's so low that it makes the most sense to hold that back to put back into the business. And in your first year, what they're really, and really in any year, what they're looking at is that you paid 100% of the tax from the previous year, or 90% of the current year. So if last year your total tax, not what you owed, like that you had to write a check for or whatever, but the line that says total tax, they're looking to see that if you paid 100% of your total tax, let's say that's 10 grand, okay? Or 90% of the current year. So if this year your total tax is 20 grand, you have to have paid 18 of that to avoid that underpayment penalty.
Gotcha.
And then because you didn't make them quarterly, they'll attach like a tiny small amount. And by tiny small, I mean, I have people that have literally owed like $250,000 and their penalty was like a couple of $1,000. So, I mean, it's not a huge penalty to really worry about.
Sweet. Thank you.
This is one that's good to be on top of, but it's not going to kill you if you didn't. All right, so we have two different things here, right? You file as a sole proprietor. Is it Andreas? I missed the name a second ago. Files as an S-corp. So let's talk about the reasons for going for an LLC filing as an S-corp, since we just have that great opportunity here.